Hey, hey, good afternoon, everyone.
Good
Hello.
afternoon, Professor.
Yeah, hi, good afternoon, DeAndre. How's everybody else?
Good
Hi,
afternoon, Professor.
good afternoon, Isora. How are you? All right, so
Good, good,
let's
good.
see. Good, very good. All right, let's see. So let me first share the screen, share my screen, and mhm. And then okay, it's being shared now. Um, okay. And let's see, there are eight people. Actually, Bria is joining, so that's going to be nine people here. And then in the discussion board, today's forum, how many are there? So 10, there are 10, except myself. So we still need a couple. Oh, okay. So one more person still needs to join the Collaborate session. Hopefully, he or she is going to join shortly. All right, and so continuing, we since yesterday we've been talking about the income statement, and we were talking. So basically, two components of the income statement. Of course, income and expenses, and they are also they break down into um, income breaks down into two sources of income, right? The primary source of income is revenue. Revenue is defined as P times Q, price times quantity sold, right? And then there is a passive income, such as investment income. Passive income, investment income. And then expenses, also two sources of expenses, direct cost and indirect cost. And the direct cost is also called, in microeconomics, is called variable cost. Okay, so that means it varies with uh, production level or output level. Okay, and then indirect cost is in microeconomics is called fixed cost because that means it doesn't change. It's fixed. It doesn't change with the production level. But variable cost changes with production level because, as I told you yesterday, direct means the cost of the direct inputs of production or direct factors of production. And we defined what are the factors of production. It's basically capital, labor, and natural resources, right? Raw material. Um, so the variable, and then obviously production level goes up, and all those inputs go up. So direct cost varies. Okay. Whereas indirect cost doesn't change with the production level, hence it's called fixed cost. It's fixed. It doesn't change with the production. Fixed, it can, what that means, it, it can change. I mean, you can have a different level of fixed cost, but that doesn't mean it changes with the production level. It doesn't change because fixed cost is mainly initial investment. Most of the fixed cost comes from the initial investment. And what is the initial investment? Think about it. Um, when you set up a company, right? And let's say this is manufacturing. Uh, a manufacturer must have the plant and equipment, right? So obviously, without plant and equipment, there can be no manufacturing. Therefore, um, a manufacturer must have plant and equipment in place before starting the production. It takes time. It costs money. It costs money and takes time, right? Because the construction will take at least a year, and then depending on the size of the plant, it may take many years. However, this initial investment is already set before you start the production, before you start the business, and then so this initial investment is fixed in that sense. Also, once it is built, once the plant is built, the value of the plant, cannot change, and it doesn't change with the production level, right? Um, and the maximum production capacity is set by the initial investment. Uh, in other words, if the plant is $5 billion, it costs $5 billion to build the plant, and obviously the production capacity of the maximum production capacity of $5 billion plant is greater than the production capacity of $1 billion plant, and roughly it would be about 5 times greater, right? So the production capacity is fixed, right? That's what is. And now, variable cost is also called CGS. Okay, anyone is familiar with this CGS? This is accounting terminology.
Is it cost of goods sold?
Yeah, it's cost of goods sold. And who was this?
Mei Chen.
Mei Chen. Okay.
I said it too, Professor.
What?
We said it at the same time, actually.
Okay, and who was that?
Tanya McPherson.
Tanya. Okay. Tanya McPherson. Okay, Tanya. Yeah. So you guys both get 0.5 for that, and this is okay. So I have to separate it from the previous class, which is business 210. So this one is fnb100. Yeah, in accounting it's called cost of goods sold, right? Cost of goods sold. Now think about it. Cost of goods sold literally means product. And what is the cost of goods sold? It's the same thing as variable cost, and I'm going to get to that. And the counterpart, accounting terminology, that's counterpart to fixed cost is called. Anybody knows what that stands for?
Operating expenses.
Operating expenses, yes. And this is DeAndre. Okay, DeAndre. Yes, operating expenses. I'll give you 0.5. Yeah. So now think about it. I'm gonna have to delete it and start a new. But let me, first, and I'm gonna get to the those things. So we now know, basically, we need to subtract expenses from income, and then we talked about it already. If we subtract expenses from income, then it's called operating profit or operating income. Although in accounting they call it operating income. Income is, I told you, income is not the very natural. Income is not the right word here, because income is gross state, and once you subtract net out something expenses, then it shouldn't be called income anymore. And more technical term is, it's the same thing, EBIT. And we defined it as earnings before interest and taxes yesterday, EBIT. Okay. But we are not at net profit yet. Operating profit is bigger than net profit. We have to subtract interest and taxes. But let me go to the next slide, next page, and so let's think about the variable cost. Why is so variable cost, also called cost of goods sold? Now let's break it down. What is variable cost? Variable, as I said, variable means because it changes, varies with the production level. So that means something depends on quantity. Quantity, means basically production level or output level, right? Quantity produced, right? Quantity produced, and then that means this is then production cost per unit. I mean, think about it. This means total cost of production, right? So if you multiply something by quantity, then this is exactly what is this? This is the production cost per unit. Cost per unit. Now, if this is called production cost per unit, another name for that is average variable cost. Average variable cost. Okay. Or AVC, average variable cost. Why? If you think about it, this is, in other words, this is the total variable cost. Isn't that right? That's the total variable cost. Total variable cost. And total variable cost is unit per unit cost, production cost times quantity. Per unit production cost times quantity is total variable cost. Now think about it. Then if you divide total by quantity, if you divide total by quantity, what should that be called? We know that if you divide total by quantity, that's total TVC by quantity, that will be per unit production cost per unit. But if you, in general, when you divide total by quantity, right, what should it be called?
It should be the average variable.
Yes, you're right. And who was this? DeAndre, okay. So you got another 0.5. Yes, of course, it should be called average. Therefore, that's why if you divide per unit production cost per unit is exactly the same thing as average variable cost, because you divided TVC, total variable cost, by quantity. Hence, average variable cost. And what does this mean? In other words, on production cost per unit is exactly average variable cost, but production cost per unit means cost of capital, labor, and natural resource, or raw material, natural resource per unit. Isn't that right? Production cost per unit is how much does it cost, how much capital does it cost per unit? How much labor does it cost to produce 1 unit? How much natural resource or raw material does it cost to produce 1 unit? Isn't that right? So that's the meaning of production cost per unit. Also, that is exactly the meaning of average variable cost, right? Now, so if you got that, now the next thing is then it's the same thing as CGS. I already, in other words, total variable cost is the same thing as CGS. Why? Because CGS is cost of goods sold. So cost of goods sold, that's the quantity sold. Isn't it right? That's the quantity sold. Right? And then so per unit production cost per unit, right? Cost per unit times quantity sold, that's exactly cost of goods sold. Isn't it right? That makes sense. Cost per unit times quantity sold is cost of goods sold. But then that's the same thing as average variable cost times quantity. However, this is, rather than to be exact, this is quantity produced, actually, if you think about it. Right? Total variable cost is actually cost per unit times quantity produced. So it may not be exactly the same thing if you think about it, because suppose you produced 1,000 units, right? That's units produced, but you could have sold only 995 units. So they may not be exactly the same, but roughly the same. And another thing, there are two things we have to assume here. One, if we assume an ideal universe, in an ideal universe, because it's an ideal universe, you have a perfect foresight. Perfect foresight means you can make an accurate forecast of demand. So your forecast of demand is perfect because it's a perfect ideal world, and you have perfect foresight. So you know that, your forecast, demand forecast, is 1,000. Your demand forecast is 1,000. So 1,000 units will be sold. So you produce exactly 1,000 units. So then units produced is exactly units sold. Eventually, the market will clear. That's called market clearing, right? Demand and supply meets, right, intersects, and then market clears. So that's basically, when we apply ideal universe assumption. But even if it is not ideal universe, even if it is not ideal universe, even in real world, real universe, if you produce 1,000 units, and then let's say you didn't, eventually you will all sell 1,000 units. Why? Suppose you sold 1,000 units, you produced 1,000 units, and this is, $50 per unit. The price is $50 per unit, let's say. And the cost, I'm going to get, of course, cost would be, below $50. If you produce 1,000 units, and you can sell up to, let's say, 955 unit and 900. Let's say 990 units. You can sell 990 units for $50, and then remaining 10 units, then the sale slows down after 990th unit. Then what happens? You drop the price to $45, and then you can sell out as long as you are willing to drop the price. Then you can sell out, right? You can exhaust all your units. So therefore, eventually, cost of cost of goods produced will be equal to cost of goods sold. Okay, that makes sense? Any questions so far? All right, I guess that everyone can. So then here's the thing. Now, okay, remember what is revenue? This is the symbol for total revenue. Total revenue. I'm not going to spell it out. So basically, we understand what total revenue is. It's price times quantity sold. Isn't that right?
Yes.
Total revenue. Yes, price times quantity sold. And then total variable cost is then average variable cost times quantity produced, which is eventually quantity sold. Right? Which is the concept of CGS, cost of, right? Now, then we know that the total cost, consists of not only variable cost, but there is fixed cost. So total fixed cost, which is a constant number. Total fixed cost is fixed, so it's a constant, isn't it right? Constant dollar amount. Why? First of all, as I told you, fixed cost in microeconomics focuses more on initial investment. Right? What is initial investment? Once again, I'm not going to repeat. That's the initial capital that went into initial capital investment that went into building this plant and equipment, right? So that is also called sunk cost. What does that mean? That investment, to build this plant, it cost you $5 billion, right? And that $5 billion is already sunk into this business, sunk into this project, right? So to recover this initial investment, to recover this sunk cost, you have to produce and sell. That's the only way you can recover this. Because it's already sunk in, $5 billion is already sunk into this project. Unless you produce and sell, there's no way to recover that, right? Does that make sense? So it's constant number. And in accounting, it's slightly different. When they say in accounting, and I told you the same thing, CGS, total fixed cost, I told you it's called total fixed cost. In accounting, it's called operating expenses. In accounting, they focus more on day-to-day, the cost that goes into day-to-day operation. And this cost doesn't change with the production level, because That means no matter how many units you produce, I mean, no matter whether production level goes up or goes down, it doesn't change. It doesn't depend on the production level. So then you might, isn't that exactly what the fixed cost is? Yes, that's what fixed cost is. But once again, fixed cost pays more attention on the initial investment, sunk cost. But in accounting, it is also included. But now let's think about this. In accounting, now think about it. If $5 billion was, this is initial investment or sunk cost, initial investment sunk into this project, you will want to recover this. And how long will it take to recover this? Of course, it will take many years, but depending on whatever you're, making and selling. But the point is, you have to start. You have to sell, and from the revenue, right? Revenue must pay for total cost that consists of total variable cost and total fixed cost, right? And think about it. This is basically, income, expenses, and when you subtract expenses from income, I told you it's called operating profit. Again, focus on the term operating. I mean, here is called operating expenses, OPEX, operating profit. What does operating mean? This from here to here, in other words, you're making, you have to make a product, right? Producing, you're a producer. You have to make, in other words, production, and production will incur cost. Production will incur cost, right? And then that you will have to sell that. From sale, you generate revenue. So from revenue, you subtract expenses, and then you arrive at this. From this point to this point, that's called operating activity. Operating activity. That's what is meant by operation. Any business operation is all about arriving at operating profit or EBIT. Right? So then for day-to-day operation, what doesn't, so basically to recover, you have to recover this. Isn't it right? And if it is 5 billion, until you recover that 5 billion, and you recover it basically from this. Isn't it right? So eventually all the cumulative total revenue must be at least greater than total fixed cost, right? And until that happens, you cannot recover that. But it's not only that, so eventually, so this is, you have to more than break even, in other words. So let me, so if let me put it this way. So this is quantity, and this is dollar value. So this is total revenue, total cost. Okay, the vertical axis represents total revenue, total cost. And horizontal axis, the output level or quantity, right? Production level. Now, of course, this is zero. This point is zero. It's 0 units, $0. Suppose you are making, we'll assume, something, you're selling something, let's say it's a computer, and you're selling, you make computer and you're selling it for $500. That's price. Then what's the unit production cost or average production cost? Let's say $300, right? And then that means $200. You think that's profit margin? Roughly, they think it is. They consider that as profit margin, but that's called gross margin. Gross margin, not exact profit. Why? First of all, then think about it. If you sell one computer, one unit of computer, it will have to cover for its production cost per unit, and then this 200 gross margin will have to cover for interest and taxes and net profit. In other words, this 200 must cover. Now, only after subtracting interest and taxes, then you arrive at net profit, right? So $200 is, at this point, it's just called, this is EBIT or operating profit, but we don't use the term EBIT or operating profit when we are dealing with just one unit. Operating profit or EBIT, those are the concepts, aggregate concepts. In other words, when you multiply it by the total number produced or total number sold. In other words, operating profit is actually a concept that's aggregate concept, aggregate, right? We are multiplying that by, this is so gross margin is actually per unit concept times quantity, right? So this 200 is gross margin, okay? But anyway, now let's think about it. So this $200 altogether is called overhead. So overhead should include, actually operating expenses is not included. So actually, here between after subtracting AVC and then fixed cost per unit fixed cost. We have to subtract both. So I should. So think about it. What? So another thing that should be subtracted is fixed cost per unit, right? Now, so actually overhead is basically consists of operating expenses, which is this operating expense, and then interest. Of course, interest and taxes are also aggregate. I mean, But when you, because we are talking about 1 unit, selling 1 unit, the interest rate, the interest borne by interest for 1 unit, tax for 1 unit, right? If you divide all of that by the quantity, then it's per unit concept. Operating expenses, interest and taxes, that's called overhead, right? Overhead. Okay, so actually, okay, it's like this. So basically, probably I forgot fixed cost per unit, but if this, let's make this 350, then this will be 150. So basically 150 will have to break into interest and taxes and net profit, right? So now I don't know if you can get the idea, but I broke down, in other words, instead of aggregate picture, I broke it down into it's the same step, but structure is the same, but if you look at it in terms of per unit, right, it will look like this. And then, so let me then again, no. No. Okay, now. Total revenue, total cost. Now think about it. This is 0. 0 unit, if you follow the horizontal axis, that means 0 unit produced. And if you follow the vertical axis, that's $0. $0. Now, think about it. The revenue will look like this. That's too steep, but let me make it then. Looks too steep. This is the shape of the total revenue. In reality, shape of the total revenue is not a straight line. It's a curve. But for now, we'll just approximate it as a straight line. Now think about it. Total revenue will be 0 when you sold 0 unit. Isn't that right? When you sell 0 unit, total revenue will be 0. But when you sell 1 unit, total revenue will be 500. Isn't that right? Price, because price is 500. Revenue is price times quantity. And if you sell 10 units, total revenue will be 5,000. If you sell 100 units, will be 50K, right? If you sell 1,000 units, $500,000. If you sell 1,000 units, $5 million. Right? Does that make sense? So that's why the total revenue curve will show linear increasing pattern. Linear. Okay? Everyone is clear about that? That makes sense? Revenue?
Yeah.
Yeah, good. At least one person is following. I don't know what what's happening with the rest. Good. All righty, good. Now, let's think about the total cost curve. Total cost curve will basically, because average variable cost or per unit production cost is 300, right? It will increase by the rate of increase will be smaller than total revenue. But let's think about it. When you sell 0 unit, when you have sold 0 unit, what will be your total cost? When you sold 0 unit, what will be your total cost?
Should be 0.
I thought you would say that, but no, it's not 0. It's a positive number.
It's just a fixed cost.
Yes, who said that? Who said that?
Mei Chen.
Mei Chen. Okay, I'll give you 1 point for that. 1 point. Yes, it's the fixed cost. Why? Think about it. Total cost doesn't start from 0, but it starts from the fixed cost and increases by $300 per unit. Why? Remember, even before you start the production, you have already incurred $5 billion initial investment, sunk cost. In other words, this level is the level of total fixed cost. So let's say if it is $5 billion, even at 0 unit, you produce nothing, you already incurred total fixed cost of $5 billion. So you start from already the total fixed cost. And then as you produce first unit, 300 plus the fixed cost. If you produce 10 units, 3,000 plus the fixed cost. If you produce 100 units, 30,000 plus the fixed cost, and so on. Now I made it to I'm sorry, I made it to flat. But so let me make it, let's say it's like, okay, that's the total cost. And I told you, total revenue is not a straight line. In reality, total revenue is a curve, right? And total cost is also a curve. It's an approximation. It's an approximation, right? So at 0 unit, it starts from TFC, and then the slope, this slope of the total cost curve increases by $300 per unit. And of course, they will intersect at some point. They will intersect at some point. So think about it. What is profit? Profit is basically, what is profit? Isn't profit basically total revenue minus, profit is total revenue minus total cost? Profit is total revenue minus total cost. Isn't that right? Isn't that right?
Yes.
Yeah. Yeah. So think about it. At this point, total revenue is equal to total cost. Total revenue is equal to total cost, right? So at that point, profit is 0 at that point. Profit is 0 because they cancel out. And that point is called break-even point. And the break-even point, they will say, this is the break-even point, but yeah, but break-even point is actually here. You have to, in other words, this is the quantity where break-even happens. This is the production level, or the output level, where the break-even happens. Now, break-even means literally the company breaks even between, they break even between revenue and cost. Hence, it's called break. They usually, they will say this is the break-even point. That's intersecting point. Yeah, so it's not too wrong, but unless you graphically explain it, when you graphically explain it, yeah, you can point to that when you graphically, when you draw the graph and explain that. But when people just verbally, explain it, you cannot point it. You cannot point it like that. So what do? You will have to explain it in terms of, oh, how many units. I mean, when we produce 1 million units, then we break even. I mean, simply these days, even the people in the movie industry, actors talk about break-even point. Even the actors talk about break-even point. Why? Because, okay, it's simple. It cost, let's say, it cost $2 billion to shoot that movie. Total cost was, then to break even, you have to sell tickets, right? Total revenue from the tickets must be equal to 2 billion. Isn't that right? And then, so then think about it. Nobody is aiming at break even. I mean, think about it. If you are doing a business, that's not your goal. Your goal is not just to break even. Why? Your goal is beyond break even, because only after break even, then the profit is positive. Now think about it. After this point, past that point, right? Profit is positive, isn't it right? Why? Because everywhere past that point, at every output level, total revenue is greater than total cost. Right? Makes sense? Then the profit is positive. But before you reach the break-even point, literally, at every level of output, total revenue is below total cost. Right? So that's why we want to know where the break-even happens. Right? We want to know where the break-even happens. So the point is not to break even, not to just break even. We have to more than break even. Isn't that right? By only, more than break even, but, only when we more than break even, then we have profit, positive profit. Before that, zero, negative profit, negative. And at break-even point, profit is zero, literally. Does that make sense? Now then think about it. Operating expenses mean basically to break even. So suppose we can calculate, we can find break-even point, and that break-even point is not in dollars but in quantity. So it will be in units. Break-even points will be in units. It can be also, we can translate into dollars, but in terms of quantity, let's say we have to sell 1 million units to break even. Then think about it. Operating expenses, we can spread operating expenses. In other words, we can divide the fixed cost. We can divide fixed cost by the break-even quantity. That will give you what should be the operating expenses per unit, right? Roughly, that will give you what should be the operating expenses per unit. I mean, if it takes 1 million units to break even, and we had, $5 billion fixed cost, initial investment, you break it, you divide it by that, and will give you some, what it takes to, how much, per unit operating expenses we have to build into our price, right? That will give you some idea. Now, of course, again, in accounting, operating expense is not just the total fixed cost, because as I told you, total fixed cost, and this means roughly equivalent to, that means approximately equal to, not equal to, right? Approximately equal to. Why? Because I told you in microeconomics, the focus is mainly on initial investment. But in accounting, is initial investment plus the day-to-day operating expenses that don't depend on output level. And what would that be? What could that be? To give you an example, think about it. Clerical staff. There are two types of workers. When you say workers, there are production workers who are production staff who are directly involved in production activity, right? And of course, production staff get paid. They get salaries. But think about it. If they work overtime, they will get overtime pay. And currently, let's say you are hiring 100 people, right, as production staff. Now think about it. If you double the production, in other words, if you double the production level, if you double the output level, what's going to happen to the level of production staff? There are two things that can happen. One, you are doubling the production level, so you'll have to double these people, right? You'll have to hire twice as many people. But realistically, that's not possible because right now you are running at, let's say, you're running at, I told you, companies generally don't run at 100% capacity. I mean, if they run at 100%, they can run 100% capacity for a short time. But no company can run at full capacity like 24/7, 365 days, because people will collapse, and then machines will break down, right? So generally, there's some slack. There's always some slack in capacity. Production staff, if you when you have to double the production, you cannot double the plant size overnight. You cannot double. In other words, machines, equipment, plant size, it cannot be doubled overnight. But at least you can probably you can. It's not realistic, but let's say you can double the you can hire twice as many people. And I'm telling you, it's not realistic. Why? First of all, production staff are skilled labor, and it's not easy to just find huge number of skilled labor. I mean, 100 people, 100 skilled labor just overnight and put it on. And what if now, if the production level goes back to normal? When production level goes back to normal, what happens to this another 100 people? They will get laid off. So in other words, first of all, so that's not realistic. More realistic solution is you make them work double shift. In other words, 100 people, they work double time. Of course, it's only for a short time, because if you do that, they will all collapse. You cannot keep running like that, for a long time. Maybe for 1 week, yeah, you raise the pitch, but that cannot. But anyway, but what I'm talking about is if you double the production level, then you will have to double the hours of the production workers, or you'll have to double the number of them. And either whether you double the hours or double the number of the production workers, it changes. I mean, because you're doubling it, variable cost, total variable cost doubles. Make sense? Think about it. You're doubling the production level. You're doubling the production level, and obviously the factor. You will also have to double the factors of production, right? Capital, labor, and raw material. The usage of the capital will have to be doubled. Number of hours will have to be doubled. Either number of hours per person will have to be doubled, or number of people will have to be doubled. And also the raw material, usage of raw material will have to be doubled. So basically, variable cost, it changes. It doubles, because that's the definition of variable cost. However, when you double the production level, do you need to double the clerical staff?
No.
No. What is clerical staff? One very good example of clerical staff is secretaries. When you double the production level, do you need to double the number of secretaries? No. Secretaries may work a little more, but then secretaries are not directly engaged in production activity, right? Administrative staff, secretaries, you don't have to double their numbers or double their hours, right? They may just put in extra hours, but you don't have to double their hours. So their pay, total pay that goes to them, is relatively constant, fixed. But the variable cost doubles. So in other words, in accounting, when we say OPEX, operating expenses, it's not only the fixed initial investment spread over the horizon, of break-even point, but also, like, these salaries paid to production workers also. So salaries paid to the clerical staff. So that is the definition of operating expenses. Okay? Now, on that note, we have explained completely in depth the logic, the reasoning, and the logic behind the operating activity. And we concluded, and then so we subtract. If we subtract, then next step is EBIT, or operating profit. So at this, I think it's a good time to take a break. It's 7:03, 7:05 now, so we'll take a 10-minute break and reconvene at like 7:05. Okay, so let's take a 10-minute break. All right.
Should be 7:05. Okay.
All right, we're back. We're back. So, okay. Before we continue, let me check one. Ifat, are you Ifat Jahan? Ifat, can you hear me, Ifat? Ifat Jahan? Okay, I'll just. Ifat, if you can hear me, I replied to your email. I don't think you have checked it yet, but I replied to your email. Please check it. All right. So 3%. Okay. Ifat Jahan is not here. Let's see. Anyway, so now that brings us to okay. So the biggest chunk is already done. So we know once again, of course, we can rewrite it. Income, first of all, primary source of income is total revenue, which is price times quantity sold, and then investment income, passive income, right? Investment income and other passive income, expenses, CGS, which is also called total variable cost, which is also called direct cost, and then OPEX, operating expenses, which is also called not exactly equal, but I should say roughly equivalent to total fixed cost, which is also called indirect cost. Indirect. So, of course, total variable cost for CGS or direct cost, it is, a average variable cost times quantity, right? And so you subtract expenses, that's called operating profit or operating expenses, also called EBIT, earnings before interest and taxes. So next, now think about it. If this result is called EBIT, and EBIT stands for earnings before interest and taxes, and how self-fulfilling or self-predicting it is. I mean, how self-predicting this terminology is. Think about it. We can tell what's going to happen next. What should happen next? Can anybody tell me what should happen next?
It should be earning before taxes. After
Say it again. Say it again.
After you pay the interest, it's earning before taxes. EBT.
After, yeah. after EBIT, you'll have to pay interest. Isn't that right? Because the name is earnings before interest and tax. Interest, you'll have to subtract, you'll have to pay interest. And if you pay interest, then it's called, if you follow this, it's called EBT, earnings before taxes. Because from EBIT, from EBIT, I is gone. You took out I because you paid interest. Then the name should be EBT, earnings before taxes. But then, if you want to, that's this column. You see, I'm using two columns for two nomenclature. You understand? The two naming systems. One, the right column is a naming system that is, almost self-explanatory or self-predicting. Left column is sort of traditional, conventional naming system, right? So from operating expenses, from operating income, you subtract interest, and then conventionally, what is that called? That is basically EBT, but what is the conventional name for EBT? Anyone?
Oh, taxable income.
Yes. Okay. DeAndre, I'll give you one. This is together with EBT. You gave subtract interest, and so I'll give you 1 point. Yes. Conventional name for that is taxable income. Conventional name is taxable income, right? Isn't that right? Isn't that exactly what earnings before taxes is? Earnings before taxes is the earnings or the profit right before getting taxed. Hence, conventional name for that is taxable income. Okay? Now, so you should recognize them, you should know them by both naming system, right? The left column and the right column. Left column is conventional nomenclature. Right column is the more technical nomenclature. I like the right column because it's quite self-predicting, right? But you should also know it by the conventional nomenclature as well, conventional terminology as well. Okay. Now, after paying, then I don't have any more space here because I ran out of space, so I cannot write any more down here. But let me. So then what? So please take screenshot of this if you can, because when I delete this, then you won't. Okay. So is that okay? I can delete this. So then, here we have now taxable income, which is also called EBT, earnings before taxes. And because the name is earnings before taxes, right? What comes next? What comes next? What do you think comes next?
It would just be earnings after taxes.
No. You cannot just come to earnings after taxes. What should happen between earnings after taxes and earnings before taxes? Come on, think logically. What comes before what comes between earnings before taxes and earnings after taxes?
Isn't that your revenue?
Revenue was already long before.
Oh, the taxes itself, just taxes.
Yeah, yes, isn't it right? Just taxes itself. Think about it. We are facing taxable income. If you have taxable income, then what comes next is taxes. Isn't it right? So we subtract taxes. Although I'm writing only in the left column, you should understand the same thing happens. You should understand that the same thing happens in the right column as well. I mean, I'm just, because taxes, it's not twice. I mean, the same thing is happening both, same thing is happening, right? I mean, taxable income, EBT is just another name for taxable income. So if taxes are subtracted from taxable income, the same thing is done here too. I'm just not writing it. I'm not just not writing it in to everywhere, but basically the same thing here. We'll have to subtract taxes, right? So after subtracting taxes, what should it be called? And you already said. Someone said, I guess DeAndre already said, yeah, it's then EAT. EAT, earnings after taxes, right? But this is, a technical name. Conventional, so what is this equal to? Conventional terminology is what?
Net profit.
Net profit, yes. Conventional terminology is net profit. Okay? All right, so DeAndre, I'm going to give you another 0.5. Net profit. So we have five. This is the end. Conclusion of the income statement. This is the conclusion of the income statement, right? And so think about it. When you say net profit, it sounds like it's a positive number. Once again, net profit can be. It's not necessarily a positive number. Net profit, or EAT, it can be a positive number, it can be zero, or it can be a negative number. Isn't that right?
Yeah, yep.
Because of course, when it is a positive number, it's profit. If it is zero, you made no profit. If it is negative, that's called net loss. Isn't that right? Net profit or net loss is basically the two sides of the same coin. I mean, if it is positive, so you can call it positive profit, that's profit. And then you can call it negative profit, and that's net loss. Isn't that right? So this is the conclusion. This is the conclusion of the income statement. And so, because some people seem to be, still not, quite sure, because look, revenue cannot come there. Revenue is what? You see, revenue is income. Please keep in mind, revenue, this is revenue, total revenue, right? Price times quantity sold, units sold, right? Quantity, units sold, right? That's quantity sold. Price times quantity sold, and then investment income. That's income. Revenue, sometimes, some companies may have only revenue, only sales revenue, right? Because they may have zero investment income. And then you subtract expenses, right? Which is CGS and OPEX. CGS is total variable cost, which is direct cost, right? OPEX is roughly equivalent to total fixed cost, which is indirect cost. Okay, so then you subtract it is called operating profit, or this is same thing as EBIT, and then because the name is EBIT, earnings before, what comes next is interest. You have to pay interest. And where does that? I'm gonna get to that. Where does the interest come from? So after subtracting interest, then this I is out, so it becomes EBT, earnings before taxes. But conventional name for that is taxable income. Now think logically, please. If you think logically, if you have earnings that's right before taxes, then you're facing taxes. That's taxable income. So then what comes next is logically then taxes must come next. Subtract taxes, right? So revenue is here. This is revenue. You cannot have any word like revenue after this level, right? You pay taxes, and then because after you pay taxes, then conventionally it's called. You see, I hate it because I cannot write anymore. It's called net income. It's called net profit, or another name for that is EAT, earnings after taxes, right? Yeah, this is a pun that can be only made in English, right? That can be only created in English. Think about it. Profit, symbol for profit is pi. Think about it. Before you pay taxes, right? Before you pay taxes, you cannot eat your pie, right? Think about it. Taxes belong to government, and before you pay taxes, you cannot eat your pie. And generally people say, as an expression, I want my piece of pie. What does that mean? I want my share of profit, right? And then before you pay taxes, you cannot eat your pie. But after paying taxes, now you can eat your pie. And this is only, this is only possible in English. I don't know. In French, I don't think they can make this type of pun, right? Or in Korean, they cannot make this kind of. In Japanese or in German or Spanish, I don't think. Not in German or Russian, never. They can make. But it's just a coincidence or happenstance. But in English language, this is possible. Now you can eat your pie. Okay. It seems like nobody gets that joke. Huh? Did you get that joke? Too bad.
Oh, it's not like pay the taxes first and then you get paid.
Then you get the profit. Now you can take the profit, right? After paying taxes, you can take the profit. So profit is net profit is EAT, earnings after taxes. You can now eat the profit. You can eat the pie, right? That's a joke that can only happen in English language. In other languages, I don't think that can happen. When you're looking at the income statement is also called P and L statement. Sometimes they write it like this, or P and L. And that's nothing. That's nothing. That's nothing. Mysterious, because P&L, profit and loss. What else can it mean, right? So P&L statement is another name for income statement, profit and loss statement. That means at the end it can be either profit or loss, right? Also, that's generally the conclusion, but that it doesn't stop. Now you thought probably that was the conclusion. Generally, yes, that's the conclusion, but actually it can go further. Why? Okay, now let's think about it. So finally we have net profit, also called EAT. Now, who does that belong to? Who does the net profit belong to? Who does that profit belong to? Anyone?
It
Huh?
belongs to the
What?
shareholders?
Yes, the shareholders.
Does it belong to
Yes.
the shareholders?
Yes, it belongs to the shareholders.
It said, Professor.
Who said that?
Tanya and DeAndre.
Tanya and who?
DeAndre.
Okay, Tanya and DeAndre. Yeah, I'll give you guys both 0.5. DeAndre racked up a lot of points today, actually. DeAndre racked up like 3 points already today. I think it's in your best interest to make sure that your connection is in best condition, because depending on the connection, even if someone says something I can't hear, it's not heard, and someone whose connection is good, it's loud and clear. So make sure your volume, first of all, your audio volume is maximum.
I won't
right?
contribute. I just won't contribute.
Huh? Were you speaking to me? Sometimes, it's all background noise, and I can barely hear you. But anyway, it belongs to the.
I will not answer
What?
questions, and then there won't be any confusion.
I'm sorry, I can barely make out what you're saying. I heard you are not gonna. I heard something like you said you were saying you're not gonna answer questions.
I just said I won't contribute anymore if it's going to be a complication. No worries.
I heard you very. I heard you very loud and clear. I mean, if your audio is like that, I don't think there's any problem. You can. That was very loud and clear a while ago. So yeah, think about it. Net profit belongs to shareholders. Why? Because the shareholders are the owners of the company. Think about it. Net profit is the fruit. Isn't it right? Net profit is the fruit that you harvest from the tree. And who does the fruit belong to? Of course, it belongs to the owner of the tree. And the owners are the shareholders of the company. But next question is, although in theory they say, yeah, it belongs to these shareholders, but does the company distribute the profit to the shareholders? Think about it. And if they distribute the profit to shareholders, when do they do that?
Yes, they do when they do the dividends.
Oh, dividends, yeah.
Yeah.
Who said that? Who said
Isaura?
dividends?
Isaura?
Isaura. Yeah, Isaura, I'll give you 0.5. But no, dividend is only a small fraction. Now you made a good point. um, that's not the whole. Dividend is not the entire profit. It's not the whole of the profit. In other words, they are not distributing the whole harvest of the entire harvest of the fruit, but they pay out dividends. But the dividend is only a small fraction of the net profit. So they pay out dividends. So dividend is something like dividend payout ratio times net EAT, net profit or E. You understand? They pay out only, let's say, 10%. That dividend payout ratio is something like 10% or 20% of the EAT. So if the EAT is 1 billion, right? They pay out only, let's say if they pay out 10%, that will be 100 million. Isn't it right? 10% of 1 billion is 100 million. They pay out only, and then what if there are 10 million shares outstanding? And there are 10 million shares outstanding, number of shares outstanding. I'll write it like. So the shareholders are holding 10 million shares. So there are 10 million shares outstanding. Okay. So 10 million shares. That's called number of shares, right? We don't even have to. Then think about it. How much is the dividend per share? It's obvious. Dividend per share is
$10?
Yes. 100 million divided by 10 million shares is going to be $10. That's dividend per share. Per share. And who said $10?
Mei Chen.
Okay, Mei Chen, I'm going to give you 0.5 for that. Yeah. So if you have one share, usually annually you probably it will be like $1 or $2.50. If you get $10 per share annually, $10 per share dividend annually, that's very hefty. So if you have 10 shares, then your dividend will be 100. If you have 100 shares, 1,000, you receive 1,000. But that's the concept of dividend. Once again, dividend is only a small fraction of the profit that is distributed. It's not the entire profit that's distributed. And so you can say, in general, companies don't distribute the profit, right? It sounds very nice when they say, oh, well, the profit belongs to the shareholders, right? It makes you feel very empowered. It makes you feel very empowered. If you're a shareholder, I'm an Amazon shareholder, I'm a Google shareholder, I'm also an Apple shareholder, I'm a shareholder of Berkshire Hathaway. What if I own just one share? Huh? Even if I own like 100 shares of Amazon, I'm just one of the minority shareholders, right? 100 shares would represent like 0.00001%, right, of the ownership. So in reality, unless you own like a majority shares, huge, like if you own 15% of Amazon, or if you own 15% of Apple, you would be. I mean, I think Jeff Bezos, he doesn't even own probably 25% of Amazon. I mean, even with about 15%, you become the majority. you become the supermajority. Supermajority is always what? Supermajority is 51%. Of course, you alone cannot become the supermajority, but you can pull together the friendly shareholders, and if the friendly shareholders vote together with you, then you control the supermajority. But anyway, the point is, dividend, although it sounds like a great thing when they say, profit belongs to the shareholders. Actually, the company doesn't distribute the profit to the shareholders. If ever they do, it's going to be a fraction of it, just a fraction of it, which is called dividend. Okay, so dividend is usually a token gesture. Theoretically, dividend is part of the profit. So think about it, if 10% is the dividend payout ratio, right? If 10% is the dividend payout ratio, then dividend will change. It will go up and down depending on the profit level. As EAT goes up, dividend will go up because if EAT goes up and by 10%, that 10% of that 10% will also go up. But if EAT goes down by 10%, the 10% of 10% will go down. Makes sense? That 10% will go down by 10%. That's in theory. Think about it. That's in theory. Do they really pay like as the profit goes up or down? Do they? Of course, there will be slight change, but in reality, it's only a token amount, symbolic amount. What dividend? So, if you have been shareholder, like Apple shareholder for a long time, or any show, you would know, regardless of quarterly earnings, right? You understand earnings, companies. Okay, so companies report earnings how often? Does anyone know how often the companies report earnings?
Quarterly,
Quarterly, yeah. Quarterly, who said that?
Saura.
Isora, okay, you got 0.5. Yes, they report earnings quarterly, right? So first quarter earning, quarter one, first quarter ends on end of March, right? First quarter earnings report is released in April. Of course, think about it. You cannot report first quarter earning exactly on the 31st day, on the last day of first quarter. You have to compile the data. You have to collect and compile the data, and then you can calculate. You have to be able to calculate EAT, earnings, net profit of the first quarter. And that report is released in the first month of the second quarter. The second quarter earnings will be released in the first month of the third quarter. It's just like that, right? Third quarter earnings report will come out in the first month of the fourth quarter. And it's called earnings season. So the first month of every quarter is called earnings season. They call it earnings season because earnings report comes out at that point. So, and then if you have noticed, every quarter, so first quarter earnings is called, let's call it EAT1, the first quarter earnings. And then second quarter earnings, will EAT2, third quarter earnings, EAT3, fourth quarter earnings, EAT4. All of these earnings numbers will fluctuate. I mean, you can have a great first quarter, but second quarter, you may have a bad quarter in the second quarter. Third quarter, you may recover. Fourth quarter, you may do very well. But then, think about it. Then the dividends, think about it. Dividends must also follow that pattern. Theoretically, dividends must follow that pattern because dividends are some percentage of net profit. Don't you think? Dividends must follow that pattern. In theory, theoretically, it should. But do they really? Does it look like that? I mean, you have great dividend, good dividend in the first quarter, poor dividend in the second quarter, good dividend in the third quarter, and great dividend in the fourth quarter. No. In reality, they just pay, regardless of their actual earnings per quarter, they pay relatively constant dividends. It's like, always, 25 cents, 25 cents, 25 cents, 25 cents. Right? Why? That means, because they actually, predetermine the earnings level and predetermine the dividend, and then regardless of the earnings, they just pay because most of the time, a lot of this dividend is mainly a signal, right? That's why I'm saying it's token amount. Just token amount. It's a signal. It's the signal effect. You're signaling. I mean, you may have a bad quarter. Second quarter was bad, but you still pay 25 cents per share. And that means what? We didn't do well in the second quarter, but we have good cash flow. We have made, we are good. We can still pay you, right? A signal effect. You understand? And another thing, dividend is not an obligation, right? So you understand operating profit, which is called EBIT. From that, you have to pay out interest. Interest is an obligation, legal obligation, because why do you have interest? Why do you have to pay out interest? Because you have debt, right? So why do you have debt? Remember sunk cost, right? Do you remember sunk cost? What's the sunk cost? It's the initial investment. You needed to raise $5 billion to build, plant and put production equipment in it. Your plant cost $5 billion. And how did you raise $5 billion? You raised it through either, equity. I mean, there are only two sources of capital, equity and debt. But equity is stock, right? If this is a startup business, if this is a startup company, it's hard to raise equity capital. Of course, if some, venture capital invests, unless venture capital invests, $5 billion, but most likely, some of it will be debt, some of it will be, venture capital, the equity from venture capital. But so think about it, $5 billion, you cannot just, raise it through equity. So you have debt. Let's say $3 billion is debt, $2 billion is equity. You have, if you borrowed money, right, you have to pay interest. So that's why it's there. And then taxable income after paying interest, taxable income, or EBT, earnings before taxes. So then you pay taxes. Then you come to EAT. And of course, another name for that, net profit. Net profit and EAT. And then you pay out dividends from the net profit. But again, dividend is, so interest is an obligation. If you don't pay interest, then you will get sued, right? If you default on interest, right? Of course, not just defaulting on it just once doesn't get you into a litigation, but if you continuously, repeatedly default on interest, then you will get sued. There will be a litigation, and you can go to it will be taken to a bankruptcy court, and they will try to get bankruptcy judgment on you. Who are they? The creditors, the lenders. Lenders will try to get a bankruptcy judgment on you, and once you are declared bankrupt by the court, then they can use that to seize your assets. They will, and if they seize your assets, what do? They will liquidate it. They will sell it off and recover their debt, right? So interest is an obligation, but dividend is not an obligation. Why? Think about it. Dividend comes from the net profit, which belongs to the shareholders, right? Which belongs to the owners, the shareholders. And as I said, dividend is mainly signal, mainly token, and then company may or may not pay dividend. It's not an obligation. It's an option. But if they pay out dividend, whatever is left. So remember, if net profit was 5 billion and they paid out 10% of it, 500 million as dividend, then after paying out dividend, you're left with, after paying out dividend, you're left with 4.5 billion. Isn't that right? What is this 4.5 billion called? Anyone? Okay, there's a lot of static, but I could hear it. Retained earnings, right? Retained earnings?
Yeah.
Yes. DeAndre?
Yes.
Okay, so you got another 0.5. Yes. Literally, it's called retained earnings. Retained earnings. Why? This is earnings after taxes, right? EAT, earnings after taxes. From that, you paid out dividend. So whatever is left is called retained earnings. Now, then think about it. I don't know if I have time to go over this, but I'm going to tell you. So if you received the dividend of 500 million, but per share, I mean, you divide it by number of shares. And let's say we assume number of share is 10 million. Was it 10 million? What did I? We'll assume it is, 100 million. So you received the dividend of 100 million, and number of share is 10 million. Number of shares. And EAT, that means EAT was $1 billion, $1 billion, right? And you divide, so So after paying 100 million dividend, right, retained earnings will be 0.9 million, 0.9 billion, 0.9 billion. Isn't that right? 0.9 billion. Now, then dividing 100 million by 10 million, dividend per share will be $10. Right? That's a lot of dividend, actually. Dividend per share, $10, a lot of shares. So let's make it 100 million. Then this will be $1. Dividend per share will be $1. Now think about it. I said dividend is an option. It's optional. You don't. It's not an obligation. You may or may not pay dividends. But if you don't pay, let's say company didn't pay any dividend. Let's say this didn't happen. Company didn't pay any dividends. What's EAT will be exactly, the entire EAT will be retained earnings. Entire EAT will, if they didn't pay any dividend, entire EAT is retained. Okay, so if they retain with retained earnings, what do? They reinvest it, called plowback. They plow back the retained earnings. In other words, it's reinvested. It gets reinvested, right? So think about it. The growth companies generally don't pay out dividends because they need all the money, they need all the capital they can grab. They need to reinvest all the capital they can grab. So because they are growing, they are growth companies, and they want to invest in their growth, right? So growth companies don't pay out dividends generally. Mature companies that don't grow much, they pay out dividends. And growth companies and the shareholders of the growth companies don't care whether they get the dividend. Why? So suppose they received. If they have, what is this? If they had $1 billion net profit or EAT, $1 billion will be plowed back. So think of it this way. I'm gonna have to. The shareholders' investment in the company is called equity. Shareholders, right? This is gonna take on. So I guess we will need more time. But basically, whether they if so this this $1 billion profit will be added to the existing equity. If equity at time 0 was 10 billion, let's say, 1 billion is profit. Profit belongs to the shareholders. So if the profit belongs to the shareholders, it's shareholders' capital. Shareholders' capital is called equity, but this 1 billion is EAT at time 1. In other words, equity at time 0, which is equity at the beginning of year 1 is 10 billion, but at the end of year 1, the company earned profit of 1 billion, the company earned a profit of 1 billion, and that 1 billion, because profit belongs to the shareholders. If it belongs to the shareholders, that's equity. The only difference, this is equity generated by operating activity. This is paid in equity, paid in capital. But anyway, this belongs to, so at the end of year one, with the EAT added to equity at time 0, equity at the end of year one will become $11 billion. Then the share price, think about it. What is the share price? Share price is, book value per share at time 0. There was $10 billion at the beginning of year one, and there were how many shares outstanding? I believe 100 million shares outstanding. There were 100 million shares outstanding. But you divide, number of shares. You divide the equity at time 0 by shares. It will be, that's $100, right? 10 billion divided by 100 million. That's $100 per share at the beginning. But then at the end, I know I will have to explain this all over again today. No matter what I do, I don't think you won't retain that much in your memory. But then book value per share at the end of year one, think about it. What is the equity at time 1, at the end of year 1? 11 billion, right? So you divide 11 billion, which is equity at time 0, equity at time 1, you divide it by 10 million shares, then it will become $110. In other words, stock price will exactly, theoretically, right? Book value of the stock price will have to exactly reflect the profit per share, or profit per share is another name for profit. What is that? EAT1 was $1 billion. That's profit, total profit, right? You divide it by number of shares, which is 100 million. Then this becomes $10. $10 is what? That's called earnings per share. Earnings per share. Earnings, I told you, earnings is the same thing as profit. It's profit per share. So in other words, okay, whether they pay dividend or not, it's the same thing. Because earnings per share will exactly increase. Book value per share. Book value per share will, from book value per share at time 0 to book value per share at time 1, the increase is exactly the earnings per share. It will so in other words, stock price will reflect exactly the earnings per share. So if they don't pay out dividends, if the shareholder sells the stock, he will recover the earnings per share, the profit, right? He will exactly realize that profit. And if they pay out dividends, he gets the $1 in dividend. And when he sells the share, he realized the capital gain of $9. So eventually it's $10, still the same story. So I guess it's just a little hard to follow at this point because we don't have time. But tomorrow, next Monday, we'll go over this again because obviously, this is an interesting part, but a lot of things were, before we got to this, we should have talked about the balance sheet and capital structure, but then it's going to be a whole, it's going to take like 2 days to go over that. So anyway, we'll have to come back to this on Monday. Okay. All righty. So, any questions so far? Any questions?
I just have one question about the exam. So for the exam that's due tonight, it's just like for self-diagnostic. Does that count toward our grade, right?
It will be supplemental grade. I mean, these two tests on ROI, they are not part of the 20%, 25%. They are not. I told you, 20. Each quiz is 20%. This is not quiz. You haven't even got the first quiz. Each quiz is 20%, and midterm and final 25, 25. So that's 90. That's 90%. They will add up to 90%, and then 10% is attendance. But with participation, it can be more than 10%. It can be 15%. I mean, in other words, the total can be more than 100%, right? So participation is very important because that's how you can. And then this ROI test, you have 2 ROI tests. They will be supplemental. For example, if you did very badly in midterm, if you did very badly in quiz 1 or quiz 2 or final, so your expected grade falls below B minus, then I will use the average of the ROI test to boost, right? To boost the lowest test score. And it may not. I mean, if your expected grade is C plus, but it may not boost it, significantly. It may not bump it. It may not bump it up to A minus, but at least marginally it can bump it up. It will bump it up to B minus or something like that, or even B. So that's the purpose of that's how it's gonna go in. Okay, it's gonna be a lot of Send me an email. Okay, to explain it verbally, it's very difficult. It's not that easy. So send me an email. I will explain it by email. Okay, in writing it will be easier. Okay. All righty.
Thank you.
All righty. Look, phonetically you are Mei-Chin, not Mei-Chin, but I respect if that's how you pronounce, then Mei-Chin. Okay. Okay. So that's all the time we have. So good luck with your second ROI test, and then have a great weekend, and I will see you next Monday. All right. Good night, everyone.
Good night. Thank you, Professor.
Good night.
All right. You're welcome. You're welcome. So I'll stop recording.